Hi everybody, my name is Rick Spooner. Welcome to this CMC Markets video where we take a look at some of the things on the agenda this week which could have the greatest impact on markets. Now, it's a huge week, of course, for market data and news releases this week, and how often do you see these big data weeks produce nothing in the way of market reaction? You wouldn't want to count on that being the case this week, though. There are so many things that could potentially have a big impact on most of the world's major markets. To cut things down a bit, I'm going to concentrate on three areas this week. I think the first are data releases that might influence market thinking on the extent to which major central banks, particularly the Fed and the ECB, are going to have policy divergence throughout 2015, with the Fed tightening rates while the ECB is still adding stimulus. The extent of that divergence is going to have a really big bearing on what happens to currency markets potentially over the next 12 months. Secondly, we have a lot of data out about the Australian economy. I think that market followers and analysts will get to the end of this week having a much clearer view on where things in the Australian economy stand. And thirdly, we've also got some potentially very sensitive information coming out about the Chinese economy. So on the question of ECB and Fed divergence, of course, the major event probably is the ECB meeting, where they'll announce their decision on stimulus. That will be released at 11:45 p.m. on Thursday, Australian Eastern Daylight Time. Now, the market is clearly expecting that the ECB will add to stimulus. The consensus view is that they will make a further cut in their deposit rate, cutting that from negative 0.2 to negative 0.3%. It's also generally expected, I think, that they will at least move out in time the minimum ending for their asset purchase program. Now, they currently have an asset purchase program of 60 billion euros per month in place. They've said that it's highly unlikely that that will finish before September 2016. Many in the markets think that that date will now be moved out to at least June 2017. What's a bit less certain is whether they will add to that program. Certainly there are quite a lot of analysts who think that that's a real possibility, that they might increase their asset program, purchase program from 60 to 70 billion euros, and or widen the range of assets that they're prepared to buy, moving down perhaps into second tier government assets as well as government bonds. As far as the markets are concerned, though, I think the key question will be how aggressive this ECB stimulus package is, and also I think, it seems to me anyway, of real importance as well will be the wording surrounding any messages designed to give the market an idea that this might only be the next step and that they are very prepared to keep on adding to stimulus if they don't get a clear path towards increased inflation. Because if that's the case and there's going to be more stimulus beyond this one, then that sets up that divergence between themselves and the Fed, with potentially bearish implications for the euro dollar, bullish implications for the US dollar, of course. Currency pairs, of course, are two-sided things. So when it comes to, say, the euro against the US dollar, it's not enough just to look at what the euro is doing. It's all about the changes in relativity between the euro and US. So the other thing that's going to be very important for the market, I think, over the next few months is going to be the outlook for how fast the Fed monetary tightening program will be. And I think a real key to that is going to be the US jobs data, and in particular signs of any improvement in wage growth in the US. So the other big event this week, I think, could be the non-farm payrolls data due on early Saturday morning, 12:30 Saturday morning Australian time. Now, as far as the jobs data itself is concerned, the market's looking for 200,000 jobs, unless there's something really unusual here in the case of a very, very bad result. The market does expect that the Fed is going to start hiking rates at its next meeting in December. But as I say, I think the market's moved beyond that to consideration of what happens after December. And one of the key things here, I think, to keep an eye on, if not this month, in the months to come, will be whether the US jobs market is really improving to the extent that wage growth is starting to pick up. That's really what the Fed wants to see. That, of course, is one of the key components of inflation, and that might cause them to start tightening faster than they're currently hinting. Now, we saw what might be a little false start, but could also be a green shoot in last month's data, where we saw a 0.4% increase in average hourly earnings, which nudged the annual or 12-month year-on-year rate up to 2.5%. Markets are expecting that to retreat back to 2.3%, but that'll be a key number to watch. If it happened to be very strong again, that could also be bullish US dollar. Now, of course, this question of central bank divergence could have a big effect on all markets. For example, amongst the many implications could be that a bigger than expected stimulus package by the ECB could be quite bullish for European stocks, particularly for the DAX. But of course, the one market that's most in the firing line potentially is the euro against the US dollar. And it's quite an interesting chart pattern there. I featured this in the Chart Signals blog post this morning, but just to recap for those who didn't see it, what we look as though we've got going on here is a falling wedge pattern in the daily chart. Now that's potentially a termination pattern in charts. It often signals the end of a trend, and the signal for that, if we were going to see that termination, and of course it's an if, would be a clear break up above the wedge support. Another thing just to be careful of though, or to watch for with these wedge patterns, is that you often see a bit of a head fake, a bit of a false break under the trend line, getting everybody bearish for things to turn around again. So just keep an eye out for that too, because you could clearly imagine that sort of thing happening as the ECB decision, for example, unfolds. Then turning quickly to the Australian data, there's a lot of it, so I'm not going to go into it in detail, but I think two categories of figures we're going to see this week. The first will be the remainder of the quarterly data for the September quarter. Now the two big figures there will be tomorrow's current account balance, but especially I think what the market will be focusing on will be this the impact of net exports on the GDP data. Now this was one of the main reasons for our GDP growth being as weak as it was in the June quarter, with the net exports having a negative 0.6% on growth. The market's looking for a big turnaround in that, and for net exports to make a positive 1% contribution to GDP, but any disappointment there would certainly have the market winding back GDP expectations. The GDP number itself expected to be released on Wednesday, or will be released at 11:30 on Wednesday. Markets looking for September to be up 0.7%. On a 6-month average, that gets us to about 1.8% per annum over the last 6 months, 2.3% year on year, and the basic message there is, I think, pretty soft, around about 2% growth, which is certainly below the trend of recent years. We'll also, of course, see the RBA decision tomorrow, Tuesday time. Not much or nothing is expected there in terms of action, and probably really not a great deal of change either in the wording of the government statement. In addition to that, though, we're going to see important partial indicators for how the economy is travelling in October. Again, a lot of it, but key numbers to look out for will include building approvals tomorrow. We're starting to see the growth in building approvals just taper off. Still a pretty strong part of the economy, but the rate of growth starting to flatten out. So our market again looking for that sort of thing with a 2.3% monthly decline. Other important data will be the trade balance on Thursday and retail sales data on Friday. Now, retail sales have been a bit on the soft side in recent months. The overall picture there has been pretty strong growth in those parts of retail sales related to housing. So certainly the renovation market and buying things for new houses has been strong. On the other hand, significant downward pricing pressure in the supermarket sector, of course, as that price war between Woolworths, Coles and Aldi continues at pace. Market looking for a bit of an improvement there, for up 0.5% for the month, and certainly the department store sales of David Jones Meyer and late on Friday Oroton gave a bit of encouragement as to what might be going on in that consumer discretionary sector. And lastly, as far as China's concerned, I think markets generally and those relating to Australian assets, Aussie dollar, commodities, and the Australian resources and mining sector are going to have a real watching brief as usual on the Chinese PMI indices. Tomorrow we'll see release of both the official and private manufacturing indices. Those are generally expected to be just show ongoing sluggish situation, with those indices at just below 50, indicating mild contraction. But importantly these days as well, pays to keep an eye out for the services PMI. That'll be out on Friday. Last month it read 52. Over the last 6 months that's been the average. It's been a bit choppy, down as low as 50.5, up as low as 53.5. Trend though around about 52, and that's a positive scenario for China, just showing the rebalancing away from the heavy manufacturing sector and towards the consumption and services part of their economy. Thanks for joining me today.